good morning and welcome back to PwC's Boardroom Forum Live, in particular, our corporate reporting series. Joining me this morning for episode 2 is Liandie Kies, an IFRS 18 expert. Welcome to the show, Liandie.
Thanks for having me, Shreeya.
My name is Shreeya, and today we'll be talking a bit more around a brand new accounting standard set to revolutionize the income statement. Liandie, when people hear about new accounting standards, there is some level of reluctance. So why on earth was there a need to change up the income statement? What was so wrong with IAS 1,
I thought you were going to say panic, but yes, reluctance is probably the better word. Yeah. So, and as I was thinking about it, it was actually issued in April last year. So it's been with us. It's been with us for a year. It becomes effective on 1 January 2027. So we kind of have 18 months to go, and even less if you're doing comparatives for half-year reporting. What is it, big picture? It's a brand new standard on the presentation of our primary financial statements. So primarily changes to the income statement, but also some consequential changes to the balance sheet and cash flow statement. But really, the crux of this amendment is on the income statement.
Okay, I think when people hear change, they get a bit nervous. You've touched on the income statement being something quite pivotal that's gonna change. Is there anything staying the same?
Yeah, so that's a good question. Yes, there are some things staying the same. The statement of changes in equity is unchanged. Everything we know and understand about other comprehensive income, when you classify something into OCI, when you recycle it out, those principles are unchanged. We're still disclosing material accounting policies. We're still disclosing significant estimates and judgments. We're still disclosing notes. So the accounting policies, there are still similarities and familiarities that we'll see in the standard. But another concept that is brand new and hasn't been captured before is this concept around management performance measures. So yes, we have our income statement, but we also have a brand new kind of feature in the standard that's been introduced for the first time.
MPMs, management performance measures. But I think it's so wonderful, Liandie, that not everything is coming 180. It's quite cathartic, quite helpful to know that we're not doing a full 180. You mentioned management performance measures, and maybe we can explore that a bit further, Liandie. Can you tell us a bit more about what that entails? Because when I hear the phrase MPMs, I think about listed companies disclosing these non-GAAP measures in fancy investor presentations. Are we actually going to see the advent of that information coming into the financial statements?
So I think it's a little bit of both.
Okay.
So accounting has evolved, and entities were already reporting management measures or alternative performance measures, whatever it ended up being called. Those were already starting to make its way into the financial statements.
Okay.
And there was a request from investors to the board to say, but it's inconsistent. How do I compare? It doesn't reconcile to anything. How do I look at these numbers? And this is the way that the board tried to address that, is to say that if you have an MPM as defined in the standard, then you need to bring those MPMs into the financial statements, and you need to do certain reconciliation so we can see how the information ties, what is being reconciled, how is management thinking about it. Now it is an outside-in test in the sense that entities are generally already providing these management performance measures, and now it's bringing that measure, if it meets the requirements, into the financials, but then also to update it to the extent that it needs to comply with the disclosures and the reconciling items.
And that's quite important, Liandie, because you said if it meets the requirements. So it's not the floodgates being open for everything coming in.
It's not. There are specific requirements. The one is that it needs to be a subtotal of profit or loss, which is quite technical. It doesn't mean, your cash flow measures, for example, are going to come in, or per share measures are going to come in. That's not the case. It isn't an assessment around what measures are there that management's presenting, and then what do I need to do in terms of IFRS 18?
Thanks, Liandie. I guess a follow-up question in keeping with the concept of management performance measures are private companies. Do private companies also need to think about these MPMs?
Yeah, so that's an interesting question, Shreeya. And one of the requirements in IFRS 18 MPMs is that it needs to be disclosed publicly. And I guess the question that comes to mind is, how public does it need to be? Now, what is clear in the standard that there's no scope exemption. There's no entity that doesn't have to consider it.
Okay.
So just because you're a private company doesn't mean it's not applicable to you. You would still have to go through the assessment to say, do I have any measures? Do I have a website? What information am I talking about? Do I meet the requirements? But there isn't, unfortunately, a scope out that kind of exempts entities from ignoring that guidance.
That's quite helpful to know. So it's one standard, irrespective of if you're public or private,
Agreed.
and we all need to apply our minds to these brand new concepts.
Agreed.
I want to come full circle back to the income statement. And you spoke a bit about the subtotals, and I was hearing some very familiar phrases, operating, for example. Can you tell us a bit more about how the structure of the income statement is going to evolve, in particularly in light of these different categories you mentioned a bit earlier on?
Yeah, so there are there is now an operating profit subtotal.
Okay.
So everybody needs to have an operating profit subtotal. Doesn't matter industry, entity, separate, consolidated. Everybody needs to have this operating profit subtotal. What goes into operating might differ depending on the entity that you're operating in. So I think the starting point is if you're in business and you're operating, probably everything sits in operating. And then the standard tells you very clearly what needs to be moved into investing, what needs to be moved into financing. Now those, operating, investing, and financing sound familiar. It sounds like kind of the cash flow statement, but I think it's important to note that those aren't the same.
They're not.
If you have something sitting in the income statement and operating, doesn't always mean it's going to be operating in the statement of cash flows when it realizes in
That's
cash.
an important nuance for us to bear in mind, I think.
Yeah, and I think the board made it clear, right? So the intention wasn't there for it to be married. If we're thinking around what needs to sit in operating, it's generally kind of everything. Or you ask yourself, well, do I have specified main business activities? Am I providing financing? Do I invest in assets? If that answer is yes, then some of the incomes and expenses that would traditionally have sat in investing and financing need to move up to the operating category. It's a new concept. It's a new principle that we have to make ourselves comfortable with. It's something that we have to apply our mind to. And it's an assessment that we do for each reporting entity. So entities can and should get to different answers because it's what's important and relevant for that entity. But it is a new and unfamiliar concept that we have to get comfortable with.
What I found particularly interesting in what you said was around comparability. So if investors put two companies together in a similar industry, hopefully it'll be easy to compare apples with apples and benefit the investor. So that's one, I guess, value from this new accounting standard, right?
Right. So that is what drove it, is to say that, consistency with identifying what is operating for an entity.
I always love understanding the commercial rationale for a new standard. I think it helps us in process the change management. Liandie, let's take it a step further, right? So you mentioned you've been engaging with the standard for about a year since it's been out. What are your top tips or lessons learned from thinking about IFRS 18 that you want our viewers to bear in mind?
Yeah, so I think there are, I think there's new principles that we have around, identifying what is an operating, what sits in the operating category. What actually also ended up being quite a change is foreign exchange.
Okay.
Where it used to be kind of net foreign exchange gains or losses, single line item, we were done. It's now moved to say that, well, no, if you have incomes and expenses in different categories and there's foreign exchange on those income and expenses, those should all be sitting in those different categories. So to be able to track them separately. And you need to do that unless there's an undue cost or effort. Now, it doesn't mean I have a policy choice that, I don't have the information available and therefore I'm going to just present it on a single line item. There is a hurdle. And the question is around evidencing that hurdle, because if you have the ability to do it for some, then you would do it for some, but not for the others. But there is a hurdle. So there's a question around updating reporting packs, what information is available, how material is it, how do I think about this? And it becomes very relevant if you have foreign exchange that arises from intergroup loans and all of those, because those are generally quite material.
Yeah.
So thinking around the impact of foreign exchange in the sets of financial statements. That would be one that I think, we didn't necessarily think it would be, as complicated as it is. And I think the other one that comes to mind is around what sits in financing activities. So it is its own little category. And I think perhaps, some would think that, well, if it's a liability on my balance sheet, it probably makes sense for it to be financing in my income statement, right? And I think that's not the case. So you can have some liabilities like employee benefits or share-based payments that'll probably sit in operating. And you can have other liabilities like loans that you expect, well, surely my interest sits in operating for the most part, but the standard is very clear around what are the incomes and expenses that sit in financing. There could be incomes and expenses on those types of instruments or liabilities that the standard actually requires you to move to operating.
Okay.
So it doesn't mean, if it was sitting in my interest line item before, it's probably fine, status quo would continue. And those would be the areas where, I'd spend some time, and especially around the information, do I have it at the granularity that the standard requires?
Wow, Liandie, it sounds like a really nuanced standard, and those are some really tricky technical concepts you won't intuitively think about when looking at the standard. So thanks for those practical insights and taking it a step further for us. IFRS 18, from dealing with management performance measures to a number of tricks when it comes to the classification of items of income and expenses. This is certainly not a standard that can be journaled away at the very last minute when it comes to financial statement preparation. Thanks for sharing your insights with us this morning, Liandie.
Thanks, Shreeya. Thanks for having me.
Join us next time for our next episode in the corporate reporting series in Boardroom Forum Live, where we'll take things down a different route and explore sustainability reporting.